Chapter 11, Retirement and Other Tax-Deferred Plans and Annuities. Learning Objective 1, the Basics. Here the government is encouraging saving among society, and for two purposes what we're going to look at here. One, saving for retirement, and the second is going to be saving for education. And the government does this with these tax beneficial plans that we're going to take a look at. It's important to know that the tax benefits that the taxpayer receives is usually in the form of a deferral of taxes. So it's not an elimination of taxes. It's not something to where you don't have to pay taxes on these plans. But often the tax that would ordinarily be incurred in the current tax year is put off to a later point in the future. And these plans are also going to be characterized in one of two ways. Either they're going to be employer-sponsored plans or individual-based plans. And we've also got some terminology that's important to take a look at and understand what the meaning of these terms are. The first is going to be annuity. So that's going to be a stream of payments that are stretched out over time, often the same amount of the payment in each of those periods. The second is going to be beneficiary, and here the beneficiary is going to be someone selected to receive something, often a distribution. An example which may be an insurance policy in which an individual is selected to receive the payment when a certain event occurs, such as the death of the insurance individual. The individual set up the insurance contract itself. They may select a beneficiary to where upon their death someone is going to receive the proceeds of the money, but the individual setting up the insurance contract may be the one paying into it over time. The third term we have here is going to be contributions, so it's going to be payments into a plan, and then distributions, so it's going to be withdrawals from a plan. Donor is going to be someone that's going to give something to someone else, donee being a recipient. And then we've got tax-deferred retirement or other plans. The other we're going to take a look at is going to be education type plans. And a trustee is going to be someone that is designated to oversee a plan or some type of organization or contract that are being set up, often in kind of estate planning purposes. Someone may set up a trust to help provide for future their heirs and other types of beneficiaries. A trustee may be somebody that's paid to kind of oversee those assets placed in the trust and that they're properly being governed in terms of the rules and terms set up within the trust. So again, tax deferral does not mean tax-free. Generally, what we're going to do is untaxed contributions. So if you receive the benefit on the front end, those distributions are going to be taxed. And converse, if the contributions are made to where they are going to be taxed, then often the distributions are not going to be taxed. So let's take a look at our first concept check. Tax-deferred retirement accounts are essentially tax-free accounts. That's going to be false. Tax deferral simply means that we may not be paying the tax in the current tax year, but the tax is going to be collected at a future tax year. Concept check 2. The period in which accumulated assets are paid to plan beneficiaries is known as the distribution period. Concept check 3. The COG plan is an example of an individual-based retirement plan, true or false. That's going to be false. COG plan is going to be an employer-based plan, often for someone that is self-employed. Concept check 4. 2 examples of employer-based retirement plans are, and then we've got an array to choose from: qualified pension plans, profit-sharing plans, a 401k, 403b, which is essentially a 401k, but often for something like a nonprofit. COG plan, which is going to be for self-employed, and then we've got a SEP and simple plans, which are going to be employer-based plans, but we may, in some instances, look at the number of employees they have. So concept check 5, distributions from pension plans are taxable if the contributions were made using dollars that were not previously taxed. That is true. Learning objective 2, employer-sponsored retirement plans. For the retirement plans, we've got employer-sponsored plans, rather. We've got that same grouping that we just saw, whether it's qualified pension or profit-sharing plan, the 401k or 403 plans, and simplified employee pensions and simple plans. And it's important to know that there are benefits of these plans to both the employers and employees. Specifically, the employer is going to get a deduction for that contribution, even though the employee is not receiving that as compensation. And then the employee gets the benefit of the fact that the plan investments are not taxed when earned. So over time, it's not a tax that's being collected on it or anything like that. That those taxes are going to be deferred up until the point of distribution, up until the point that the employee is going to withdraw that amount. And then we've got defined contribution plans are going to be the way to pre-establish the amount contributed. That's going to be something like your 401k plan or your 403b plan, to where you set up with the employee the amount that's going to get put into the plan, and then whatever the employee has upon retirement or at the conclusion of the plan, once distributions begin to be made, it is what it is. In contrast, these defined benefit plans pre-establish the amount that's going to be available to the employee upon retirement or available to the employee for distribution. However, the amount that needs to be contributed into the plans on the front end depends on a variety of different factors, such as the amount of return that can be made while those contributions are being made. So the defined benefit plan, the employee knows how much they were going to receive on the back end, but the employer doesn't necessarily know how much they're going to put in on the front end. And then the defined contribution plans, the employer knows how much the cost is going to be, how much they're putting in, but the employee may have some uncertainty with respect to how much money will be there upon when the distributions are being made. So the qualified pension and profit sharing plans, they need to be non-discriminatory, minimum vesting rules. They're going to also have a threshold amount that's going to be associated with them, to where defined contribution plans cannot exceed $56,000 or the amount that the employee is making 100% of the compensation. And defined benefit plans cannot result in benefits more than either $225,000 or again that compensation. Here, 100% of the compensation is taken as the average over the high 3 years. So 401k plan, again, has to meet the non-discrimination rules. Employees can elect to defer up to $19,000 per year, and then an additional $6,000 is going to be available if the taxpayer is going to be age 50 or over. Again, the KIG plans are going to be for self-employed. Contribution limits are generally going to be the same, so it's $56,000 or whatever that contribution, whatever that compensation is. The simplified employee pensions are going to be an employer-created and contributes to an employee's IRA. And the maximum contribution is going to be have those compensation limits as well. Compensation being $280,000 for max, and 25% of that compensation, or $56,000 is what's set out here. The simple plans are going to be the employer-created IRA or 401k for the employee. Employee is going to contribute up to a percentage up to $13,000, and again, an additional amount if age 50 or over here, $3,000. An employer can make matching contributions of 3% for all employees, or if you're only designated eligible employees, then that amount's going to get lowered for matching to 2%. So let's take a look at a concept check. Concept check 1 is going to be qualified pension plans are either defined something or defined something. Here it's going to be defined benefit plans or defined contribution plans. Concept check 2, employees must make contributions to qualified pension plans. That's going to be false. So the qualified pension plans, individual may receive a distribution at the end, but it's going to be the employer making those contributions to it, and the employer is going to receive that deduction on the front end, even though the employee may not be receiving that as compensation immediately. And then concept check 3, the maximum contribution to a 401k plan is, and this for individuals under age 50 is going to be $19,000. You'll get the additional $6,000 if over the age of 50. So concept check 4, a KIG plan is used by self-employed individuals. That is true. And concept check 5, a simple plan can be used by employers with 100 or fewer employees who also meet other requirements. And that is also true. Learning objective 3, individual sponsored retirement plans. So a traditional IRA and Roth IRA contributions are going to be limited to either $6,000 or whatever the compensation is. If you're age 50 or over, the dollar limit's going to be $7,000. The traditional IRA and the Roth IRA are going to differ in terms of when that tax benefit's going to result, though. So individuals covered by an employer plan, something like that 401k or a pension plan, they're going to have deductible contribution amounts that begin to phase out when the AGI reaches $103,000 for married filers or $64,000 for all others, and it's going to phase out completely at $123,000, $74,000 for all others. And married filing separately, the phase out is going to start at $0. So essentially taking that out of consideration for the tax deduction. Now you can still make the contributions up to $6,000 or $7,000 for these plans. You just don't get the deductibility of them. And then married taxpayers, if they're both employed and neither are covered by an employer plan, then both spouses can make the contribution up to the limits. If only one spouse is employed and not covered, then both can contribute up to the maximum. If one spouse is covered under an employer plan and the other is not, the non-covered spouse can contribute up to the dollar limits if AGI is going to be less than $193,000. Roth IRA contributions are not deductible, but the withdrawals are not taxable. So the traditional IRA, you're going to get that deduction that we took a look at on the front end, and you're going to have taxable withdrawals. The Roth IRA is not going to be deductible, so it's essentially going to be already taxed money that is in the distribution, within the contribution, but the amount is not going to be taxed upon distribution when the withdrawals are made. The contribution limits are going to be the same as with the traditional IRA. Here, however, the phase out is going to start at $193,000 for married filing jointly and $122,000 for others, married filing single, again at $0. And the phase out range is going to be $10,000 for married filing jointly, so $193 to $203, and then for all others $15,000, so $122 to $137. And traditional IRA versus the Roth IRA, contributions are deductible for the traditional IRA, but not for the Roth. So if you contribute up to that $6,000, you can use it as a deduction if it's a traditional IRA you're contributing to. Roth IRA is going to be after-tax money. Distributions, however, are going to be taxable from that traditional IRA when the withdrawals are made. Our Roth IRA is going to be tax-free distributions. So taxpayers are trading off the non-deductibility against the non-taxability. Non-deductibility happening at the contribution, so early on, and non-taxability happening at the distribution, so towards the retirement end. So let's take a look at a concept check. Two types of individual sponsored retirement plans are, and here we have the traditional IRA and the Roth IRA. Concept check 2. A single individual age 58 with wages of $30,000 can make a tax deductible contribution up to and that's going to be $7,000 to a traditional IRA. And the reason why is it's $6,000, but you get the additional $1,000 for age, the individual being over the age of 50 here. Concept check 3. A married couple who are not participants in an employer retirement plan with earned income of $200,000 are ineligible to make a deductible contribution to a traditional IRA. So that is going to be false. And the reason why is they are not. So the AGI phase out is only going to be for when the individuals are participants in the employer retirement plan. Here, our taxpayers are not participants in it, so they would not, their earned income would not trigger the phase out, making them ineligible for the deductible contribution. And then concept check 4. Generally, distributions from a Roth IRA are not taxable, and that is true. Learning objective 4, tax-deferred non-retirement plans. So in addition to saving for something like retirement, the government also incentivizes saving for educational purposes. And the first we're going to look at here is going to be the Coverdell Education Savings Account. Here, contributions are not deductible, and the account grows tax-free, and distributions are not going to be taxable if used exclusively to pay higher education expenses. So even though the rules are going to be different if you're trying to place it somewhere in terms of the way that the account is going to behave, think about it more like the Roth IRA and less like the traditional IRA. But those distributions, the withdrawals, have to be used to pay that higher education expenses of a beneficiary. And any person can establish a fund, the Coverdell Education Savings Account, for any person, and that includes the taxpayer themselves. The contribution limit is going to be limited to $2,000 per beneficiary from all sources, and it's going to phase out when the adjusted gross income of the contributor reaches $190,000 for married filing jointly, $95,000 for others, and then totally phased out at $220,000 for married filing jointly, and $110,000 for all others. Now, with the Coverdell, you've got maybe some more flexibility in terms of what you put those assets into, but it's not necessarily going to get tax benefits at a state level. And then, so an alternative that a lot of taxpayers will look at is a qualified tuition plan for a state-based plan for future educational costs. These are also known as 529 plans from the tax code that they're based on. So here the earnings grow tax-free and can be used for qualified educational expenses at qualified educational institutions. And that's going to include tuition and those mandatory fees, required books, supplies, and equipment, computers, software, and here room and board. So it's important to note sometimes room and board is going to be included, sometimes it's not, depending on what we've seen in the past. Here we are able to use these 529 plans to pay room and board, but only if the beneficiary is attending at least half-time. You can also use up to $10,000 per year for tuition at K through 12 schools. So this would be if a beneficiary were to attend, say, a private high school or private elementary or middle school, then $10,000, but only for the tuition is what that's going to be used for. Non-qualified distribution, so if you take money out and don't use it for one of the intended purposes, it's going to be taxable, and it's also going to be subject to a 10% penalty. The amount can be rolled over into a qualified tuition plan for another family member. So where this might come into play is if you had a qualified tuition plan set up for one child, and that child earned a scholarship to the university, and everything was covered, and they didn't need the 529 plan proceeds to pay for that. However, you are still funding the plan of another child. Taxpayer may be able to take the qualified tuition plan and roll that into that other beneficiary's qualified tuition plan. And you can use these in concert, so you can use the Coverdell and the qualified you can contribute to the Coverdell and the qualified tuition plans in the same year, and can claim credit or tuition fee deduction and the qualified tuition plan withdrawal as long as the expenses are not used twice. So if you use the qualified tuition plan for paying a portion of the tuition, that portion can't be used for another purpose. Concept check 1, contributions to Coverdell education savings accounts are not deductible. That's going to be true. Concept check 2, the maximum annual contribution to a CESA is, and the answer is going to here be $2,000. Concept check 3, contributions to a Coverdell education savings account begins to be phased out when the AGI reaches $95,000 for a single taxpayer. Concept check 4, distributions from a qualified tuition plan can be used for a computer used by the beneficiary student, and here that's going to be true. Computers are included. Learning objective 5, distributions. Generally, distributions are taxable if contributions were deductible. So if you were able to take that tax benefit on the front end during the contributions, the distributions are going to be taxable. The issue we're going to have here is when some but not all the contributions were made with previously taxed dollars. So if you had a traditional IRA set up and during some of the years you still made your $6,000 contribution but did not receive the tax benefit for it, then distributions may be partially tax-free and partially taxable. And then what we're going to use a simplified method for that. So here we're going to determine the number of anticipated payments using a single life or dual life table, and then the total contributions from previously taxed dollars. And what we do is just take that fraction. So we're going to take all the previously taxed dollars and then divide by the number of payments, and that's going to represent the proportion of each payment that is tax-free. So if we paid taxes on the amount before, then we're not going to get taxed on the distribution. And some plans are going to have required minimum distributions that begin April 1st of the year following when the taxpayer reaches age 70 and a half. And those required minimum distributions are going to be based on life expectancy tables from the IRS. So Roth IRA distributions are generally not taxable. And the earnings would be taxable, however, if you withdraw prior to the initial 5-year holding period. That's going to be for retirement. If we're thinking about it for education, Coverdell education savings accounts are going to be tax-free, again, only if used to pay for those qualified education expenses of the beneficiary. And then for those expenses, to where if you're using the Coverdell education savings account to pay for those education expenses, you can't also claim those expenses for either the Hope credit or the lifetime learning credit. And for premature distributions are generally subject to a 10% penalty. Rollovers of the plans are generally going to be tax-free. So if you roll over to a Roth IRA, however, it's generally going to be taxable. And then if rollover dollars are distributed to the taxpayer, a 6-day window to deposit new money in the new plan. Otherwise, the entire amount is taxable. Concept check 1. A participant in a defined benefit plan is only entitled to a stream of payments. That's going to be true. Concept check 2. Distributions from qualified pension plans may be taxable, non-taxable, or both. And that is also true. Concept check 3. The number of anticipated payments from a pension plan for a single individual age 68 would be 210. Concept check 4. The number of anticipated payments from a pension plan for a married couple ages 59 and 63 would be 310. Concept check 5. Distributions are required from a traditional IRA. That is true. Next concept check. IRA distributions are taxable if funded with deductible contributions. That is true. And the next concept check, distributions are never required from a Roth IRA. And that is true. For an individual age 65, Roth IRA distributions are not taxable if they have been held at least 5 years. And that is true, so that's going to be our 5-year holding period. And the next concept check, distributions from Coverdell Education Savings Accounts can be used for any purpose once the beneficiary reaches age 30. That's going to be false. Those distributions need to be used for qualified educational purposes for the beneficiary. Learning objective 6, annuities. So the annuity is going to be a series of payments pursuant to a contract. So pay in an amount of money, and then the idea is to receive a stream of payments, either a fixed number of payments or based on life expectancy. And normally those annuity payments are going to be partially taxable and partially tax-free. The tax-free amount is going to be based on the cost of the annuity contract. So if it's money you're putting into it, based on the annuity contract and the expected return. So if it's money that you're putting into it, the portion of the payment that's represented by the cost is the amount of the contract is the amount that should be tax-free in that. And the calculation we would use for that, where if the contract is for a specified number of time, we're going to take the expected return for the periodic payments and multiply that by the number of payments. If it's for life, then we're going to refer to those life expectancy tables to determine the length of time. And here, the expected total amount of the recipient is going to anticipate receiving over that annuity contract. So let's take a look at our last concept check. For 1, an annuity is, and that's going to be a series of payments under the contract. Concept check 2. The annuity payments are always the same amount each period. That is going to be false. Generally, annuity payments, the way we think about them, they're going to be the same for each period, but they don't need to be. And then concept check 3, annuity payments often have a taxable component and a non-taxable component. And that is going to be true, with the non-taxable component relating to the cost of the annuity or the cost of the contract for the amount that the individual has put into it.